we not speak about the, yes, still there. What is it? I'm exiting. Avinash, you take, I'll come again.
Okay.
You take over, and Professor Dr. Hemchand will start. I'm exiting, I'll come again.
हेमचंद जी आप प्लीज आप शुरू कर दीजिए वेलकम से.
I request Hemchand ji to give a welcome address, sir.
Thank you, Avinash ji. Let me welcome all the speakers, all our past presidents, various participants, executive member of the CA Institute of Chartered Accountant, as well as our Indian Accounting Association. First of all, I would like to welcome all of you on behalf of Deen Dayal Upadhyay College. In the NIRF ranking, our college is the 15th in the whole country, and on behalf of the college, I welcome you all. Secondly, on behalf of the Indian Accounting Association, I welcome Professor G. Soral, Professor Achmapati ji, and other executive members, past presidents, on the occasion of the 3-day certificate course on Ind AS. I also welcome on behalf of the Voice of CA, Shri Sanjay ji, Shri Avinash ji. I welcome you all on the occasion of this particular certificate course. I hope this certificate course will enhance the knowledge level of all the participants, and they will do better in their career. Without spending much time, now I will request the host to proceed further. Thank you.
Thank you, Hemchand ji. Now I request Dr. G. Soral ji to give his inaugural address.
Just a minute, Avinash. I would give introduction of Soral ji. Good evening, everyone. We'll start the program of today with a brief introduction of Professor G. Soral. In fact, Professor G. Soral needs no introduction in the accounting academic world. Must have heard about late T.S. Grewal Saab, who used to say that you scratch my skin and you will find debit and credit underneath. And I'm proud to say that the same is applicable to Professor G. Soral, because accounting research and accounting association is something which are deeply ingrained in Professor G. Soral. At present, he is All India President of Indian Accounting Association, which is an all India body having branches and chapters all over the country. And it is because of his constant efforts that we have so many webinars taking place at different places of the country on different aspects of accounting with good participants also. At the same time, at present, he is the Dean and Head of Department of Accountancy and Statistics at Mohanlal Sukhdia University, Uddaipur. An alumnus of IIM Ahmedabad, he has more than 50 research papers to his credit. Besides that, he is the chairman and member of many academic bodies, board of studies of many universities across the country. In fact, when this program was being designed, the first name which came to our mind for inauguration was that of Professor G. Soral. I rang him up, asking him, requesting him to address us for this webinar, and immediately, without thinking twice, he said, yes, it's my pleasure, showing his dedication to the profession and in particular to the Accounting Association. I, Dr. Anil Kumar, on behalf of Indian Accounting Association and the co-organizers, that is Voice of CA and Deen Dayal Upadhyay College, welcome you, sir, to this forum and request you to deliver the inaugural address. Professor G. Soral ji.
Thank you, Anilji, for the nice words. Good evening to all participants and those who are on the guest panel here. I am glad to declare this certificate course on Ind AS for 3 days open and to inaugurate this here. There is some 1 minute. Is there an error? Anilji, am I audible?
Yes, please go ahead, sir.
There is some window appearing. Anyway, let me continue. There may be some glitch here. Some message was there. The organizers, which include the voice of CA, all office bearers, I have just got an opportunity to look at them and read their names. The Indian Accounting Association Delhi branch and the Deen Dayal Upadhyay College, the principal of which is our branch chairman also. All stalwarts in the CA fraternity, of whom I would like to name Nilesh Vikamsey ji, because there was a moment in Uddaipur when he was president, I believe. Somebody recommended him to me for inviting him to a big conference here. So we couldn't make it, but today I'm very happy to see you, sir. Meet you through the webinar here. CA MP Vijay Kumar and the other representatives of the organizing body here. My senior past presidents of Indian Accounting Association and the good number of delegates which this program attracted. I was told that there are about 1,800 registrations, which is really an overwhelming figure, and that really makes me very happy as an old teacher in the fraternity. Anilji introduced me in very nice words, but friends, I would like to add one more part to my introduction here, with permission of you all. I am completing the 4th decade of teaching in the fraternity. This year I will be superannuating from my services and had a long tenure at the universities. And you may understand that I must have seen teaching accounting at the undergraduation, post-graduation level, writing PhDs in accounting for a long duration of time. And therefore it is so heartening to me to see that you design course of certification for Ind AS with these stalwart chartered accountants to address it, who I don't know how to find time. They must have been very busy in their professional affairs, but they have come here for academic purposes, and that way I also came to know this voice of CA, maybe that it was existing earlier also. I could know about it through Anilji only a few days back. So at the outset, I would express my accolades to the CA fraternity in particular for coming up for the academic cause in such a serious manner here. Few years back, I think it was 7 years back or something like that, I had a nice occasion to meet with the CA Amarjit Chopra Sahab. We all know him, that how he is the founder of all these things. Okay. We were in a seminar that time. It was in Hyderabad. Professor Achilapati ji is also there in the audience. He knows, he organized that. And we, once after sharing the test, we were discussing on these issues. And he motivated me quite a lot to introduce the IFRS that time in the courses of universities. And it was his instance that as back as somewhere 2012, we in our university, the Mohanlal Sukhdia University, Uddaipur, introduced IFRS, and you all will be glad to know that we introduced IFRS not in a cursory way, but we introduced in a very big and serious way. Like we have 4 semesters in our post-graduation. Each semester have 6 papers. 1 paper of IFRS was there in all the 4 semesters. That way, a very wide coverage and in-depth detailed study of IFRS. We started way back 7-8 years before. And that must have definitely resulted because many of our old students later on picked up the way of working on IFRS for their PhDs. Many of them have become lecturers in various universities teaching IFRS now because they studied at their post-graduation level. And the convergence in form of Ind AS, as all of you we know, that has taken place, and now gradually we are moving towards complete convergence. Amarjit Saab that time also mentioned, I don't know whether he is listening to me at the moment, that he said in his remarks that time that India is going to be a stopgap type of situation, and instead of Chartered Accountants of India is also foreseeing for a complete convergence, total convergence. We have found that gradually we are step by step moving in that direction. But friends, the point which I would like to make today in this brief time which I have been allotted, because as I have told, I am an old teacher of accounting. My many contemporaries also sitting here, that how the world of accounting, how the complexities, quality of measurement in accounting, reporting has grown over particularly last 10, 15 years. Particularly once IFRS have come and then Ind AS have been applied in the country. And many of my chartered accountant friends, large number of them are my students also, they used to mention that our days have changed. It has become very complex as compared to earlier days. Now to prepare accounts, now to audit them. And at the academic fraternity level, I am also of the same view. Now teaching accounting has become a really detailed effort on our part. Those days I used to study in my schools and colleges, and when I learned bookkeeping and accounting at the very initial stages, you see, few sets of rules were there and you easily can prepare the accounts. But now we will know about it, that where we have gone, what extent. So friends, my point today, because we are going to listen to, the senior chartered accountants delivering regarding Ind AS here. The point which I would like to make here is that I also would like to mention continuation. I had some meetings with the members of the International Accounting Standard Board also, IASB, in last 4 or 5 weeks. And there I was just discussing with them in what way they are coming up with the IFRS, on the basis of which, after some carve-outs, they have come up with the Ind AS. So the type of details which I could get from them told me that a very, very rigorous, detailed, marathon, comprehensive effort is being made at the level of IASB to develop the IFRS. You see, big teams of accountants, professionals, academics all over the world are just trying to churn up one particular point which we find later on as a section in the IFRS. So my offer to you, because I at the moment represent Indian Accounting Association here, to the practicing fraternity, the seniors of which are also in the same audience, is that we need a great collaboration in academics and practitioners in form of chartered accountants to particularly research those areas of accounting which are still unexplored, which all of us know, and where the decisive pattern of accounting is yet to emerge. Because in academic fraternity, we have a good fleet of researchers. We have doctoral researchers. Government is promoting doctoral research at the university level at the moment. But we definitely need the support and collaboration from the practitioners. So friends, this would be a call from my side, a humble call from my side. Then let us join hands together. And before concluding, I would also like to say, somewhere I feel that I can definitely share with you, you are my own countrymen, that in accounting, somewhere we are lacking actually. We from India may also not contribute to accounting fraud, as we find that many Western countries are doing. So with that, I conclude. My time was 5-6 minutes. That's over. I think once again the organizers are inviting me here and giving me this opportunity. Thank you very much.
Thanks a lot, sir, for devoting time, and I think you will be with us for the whole of the day today. Now I would request Karthik Jindal to do the honors of introducing past president and my council colleague, and we worked together for 9 years to introduce him.
Thank you, sir. Today in this Ind AS certification course, let me give a small introduction of our special guest. He is a chartered accountant by profession, having experience of more than 35 years. He is the senior partner of Shivji and Company. He is the honorable past president of the Institute of Chartered Accountants of India. He is also holding directorship in various public companies. He is a man of wisdom. He is none other than CA Nilesh Vikamsey, sir. Over to you, Sanjay, sir, for kind
Avinash?
Yes, sir.
Sanjay, sir.
Yeah, thank you. Thank you, Karthik. Please mute yourself. Yeah,
Nilesh is unmuted.
Are you able to see me now?
yeah.
I think I just logged off for a minute. It just got disconnected. Is
I
that fine?
think you are from two devices. That is why this problem is coming.
No, I'm not on two devices. I got just got AirPods on.
एक देखो कोई दिक्कत नहीं come continue
Okay, sir. Please, sir.
नहीं उनको वो नहीं आ रही है वीडियो नहीं आ रही है
Is the voice clear?
म्यूट
Yes, sir. Voice is clear, sir.
Okay, fine. Thank you, Karthik. Of course, I'm only part of the introduction, but thanks for your kind introduction. First of all, let me compliment my very, very dear friend, Sanjay Agarwal, who has been my colleague. We both joined the council together in 2010, and we spent 9 years together working shoulder on shoulder on all the professional matters facing the profession. And he's been a tremendous contributor for the development of the profession, and I wish him God's strength in whatever he is desiring to do. I also wish to compliment the Deen Dayal Upadhyay College for joining in this particular, course, certificate course for the beginners, which has been planned by the Voice of CA, which has been led by Sanjay Agarwal ji. And the fact that I'm very, very pleased that Dr. Hemchand Jain, the principal, the inaugural remarks. More importantly, I'm very happy. I was very happy to listen to. Is the voice okay?
Yes, sir.
It's okay now. Please continue, sir.
Thank you. And I was very, very happy to listen to Dr. Anil Kumar, the Secretary of the Indian Accounting Association, and more importantly, Professor G. Soral, the Dean and Head of the Department of Accountancy and Statistics at the ML Sukhdia University, Uddaipur, and who spoke. And I was very much impressed by the fact that the Sukhdia University has introduced the IFRS course 8 years back. I think that has been one of the biggest, I would say, achievements. If I can see, there's been so much desire in the CA Institute. What we have been seeing is accounting is growing by leaps and bounds. Accounting knowledge is increasing by leaps and bounds. But somehow, in our Indian, I would say, university and the systems, still the accounting what is being taught is very, very basic. And I think it needs to catch up as far as in case you want to compete with the world. And I'm really amazed that the Sukhdia University started the IFRS courses 8 years back, introduced IFRS in the syllabus 8 years back. Another thing which Soralji mentioned was about the collaboration which is required between the profession and the academics. And I'm again, I believe we as Indians, like currently what is happening on the accounting sphere is we are sort of accepting what is being developed in the world at the IASB level. And sort of, I would say this, though we say it is Indian Converged Standards of IFRS, but it is basically, the replica of IFRS. But we do have original, I would say, it is in our blood. The accounting is in our blood, and we can contribute to international standard setting and development. And we need to do a lot of things in the R&D and make our name. And I'll speak more about it slightly later. So thank you, Professor Soral, for your very, very impressive initial remarks. I'm really happy to be sharing this dais with you. Then I have a very, very dear friend, MP Vijay Kumar, who's currently the chairman of Accounting Standard Board, who's going to be the main speaker of the day. And let me tell you, I think Institute could not have been better blessed by the fact that MP Vijay Kumar is there in the council, and currently till last 3 years he was the vice chairman of the Accounting Standard Board, and now he's the chairman. A person with, of course, his formal introduction will happen, who's seen both sides of the table. I would say he's been on the practicing side, he's been on the industry side, and more importantly, who's a teacher by, I would say, his core. I think initially is teaching. If you go down south, friends, I don't know how many friends are from south. If they're from north, he is the Amitabh Bachchan of South for the CA students there. So that is the type of speaker which Sanjay has got for you. So it's an honor to be with this very august audience. I've got a 5-minute role now and a 15-minute role to sum up MP Vijay Kumar's session. What I'm planning to do is take some 15 minutes, which has been slotted for me for summing up. I'm going to use 10 minutes now, and 15 minutes I'll give a little bit of background. Since this is a beginner's course, certificate course for beginners on Ind AS, I said, let me just give a little bit of history. As we know, accounting is almost as age old as the humankind. Accounting is in its baby steps started in our, maybe centuries and centuries ago. But in a nearer back, a little bit history from the institute perspective. In the institute, the Accounting Standard Board was set up in 1977. And the first accounting standard came up in 1979, which is the AS1. And between the first accounting standard to AS15, which came in 1995, almost in 15 years, 15 standards came. From 95 to 2001, there's a vacuum. And from 2001 to 2002 especially, almost AS16 to AS28 came, about 12, 13 standards. And AS29 coming in 2003. So there was a huge bulk of standards coming in those 2 years. And people like us had to study all those at a particular point of time. And later on, Institute did come out with the standards on the financial instruments, which is that time corresponding to IAS 39, IAS 32, and IFRS 7. There are 3 standards on financial instruments then, and which were correspondingly brought in as AS 30, 31, 32, and but which was recommended, which could not be made mandatory because by that time the financial crisis happened in 2008, and these standards are kept in abeyance. And then ultimately IFRS 9 came, which is the Ind AS 109. So friends, this Accounting Standards Board, as we say, the general impression is this is formed by the council members and some co-opted chartered accountants. No, it's not so. This is representation of the Department of Company Affairs earlier and now what we call the Ministry of Corporate Affairs, the Comptroller and Auditor General, the Reserve Bank of India, the Securities and Exchange Board of India, the earlier Central Board of Excise and Customs, now whatever the new name is, the Central Board of Direct Taxes, the Company Secretary Institute, Cost Accounting Institute, and then there are co-opted members. So this is, an industry association. I forgot to mention the industry association, the FICCI, CII, SOCAM, some of them have their representatives. So this is number one, not, generally the impression is we as accountants, we make the standards, we follow it and all. No, these standards run through a lot of rigor. And in the preparatory stage itself, there is all these people who are there in the standards board. And apart from that, each and every standard, there is a public exposure, a public can comment if they find something is wrong. So it's not as if, and all those comments are seen line by line and debated in the accounting standard before the standards come into being. So this was the background from 1977 onwards, as far as the institute is concerned. Of course, the accounting standards also came out with the preface to the accounting standards and as also the framework of preparation of the financial statements. Initially, the standards were recommended to the accounting standards before I get into Ind AS. From 1979, when the first standard came till 1991, they were recommendatory. From 1st April 91, 5 standards became mandatory, accounting standards, predominantly to corporates, and the non-corporates, it was deferred to 1st of April 93, the applicability. And then gradually all the other standards started becoming mandatory. But these were still only mandatory by the institute. It didn't have the teeth. It was not made mandatory under the various regulations. So the first step in that direction came under the Companies Act, when the government made it mandatory on 7th of December 2006 under Section 211 of the Companies Act. That is almost 16 years, 15, 16 years after the standards became made mandatory by the institute. So these have been the backdrop. And of course, let me tell you, these standards have been kept on being revised. Even the standards from AS1 to AS29, friends, the general belief currently when we discuss Ind AS is, why do we want to do Ind AS? Why do we want to follow IFRS? We should develop our own standards the way we have got the old standards. But people forget the earlier standards, AS1 to AS29, also are nothing but following the international standards. Then that time they were called the International Accounting Standards. Now we call it International Financial Reporting Standards. So that's the only difference. But all those standards which come AS1 to AS29, I think barring AS22, which is substantially different from the corresponding standard. I think other than that, most of them are following the international accounting standards. So we have never been creating original standards, if I may say so. It has always been following. Yeah. Having said that, let me tell you, I joined the council in 2010, and after that, a lot of work. I'll discuss more about that. But for the first time, India came out with a guidance note on rate regulated entities, the companies like power companies, the electricity companies and all, and how those accounting has to happen. And under the leadership of my, vice president, who later on became the president, Avinash Gupta ji, that standard, the rate regulated entity, we brought it to the international table. So that was the initial one of original work which the institute did and brought it to the international table. The standards which came earlier, some relaxations and exemptions were given to small and medium companies and the small and medium enterprises. And on one point, there was a very major difference between the government and us. 2008 financial crisis happened, and government wanted relaxation of the accounting standard 9 on foreign exchange difference. And that time there was a disagreement. The government amended the corresponding standard. Companies Act, the institute didn't amend, which I think lately when I was in council in maybe 2016, 17 or something, we amended 16, 17 or 17, 18 and made it, contemporary with the government. The relaxation which was given in that particular year was given by the institute also, because we give it in the Ind AS. Another facet, friends, is I think all of us have sort of learned accounting, and we always believe, on the true and fair view of the balance sheet. And sometimes I'm amazed. There's so much work to do in accounting, the research and development, which Professor Soral mentioned. And one thing which amazed me, I can just share with you. We said the accounts were true and fair before AS 22 came, the deferred tax accounting. The moment deferred tax came, the whole picture of tax liability, we had at those times very glamorous companies, which are still there, Reliance and all, paying only zero tax. And say zero tax companies which were there, because they used to invest in the projects, claim huge investment allowance, etc., depreciation, and the tax liability used to be zero, the current tax liability. But so after deferred tax came, so it's a completely new facet for, I would say, followers of accounting like me, that accounts can be true and fair view without the deferred tax earlier and now with the deferred tax. And something similar is happening now with the lease standard. All of us know you acquire some property on rent. Normally, what we have been doing is we have been charging off the rent to the revenue, to the P&L. And suddenly a new standard comes and say, no, what you're doing is wrong. You sort of have a right to use asset, which you take in your balance as an intangible asset. You have the equivalent liability, and only the balance, the finance cost, and the depreciation will be your charge instead of the rent cost. So these are the things which are, so that's why I think, as Professor Soral said, we need to keep on doing the R&D in this particular and the newer areas which are coming up. The world is changing very fast, and that will be helpful. As we say earlier, Institute used to come out with interpretation accounting standards, but when the government sort of notified the standard, government said, you please don't count it, please make it in the standard itself. So we merged all the interpretation into the standards. And in the world, there are two major type of standards which are there. One is, of course, most of the countries are following the IFRS standards, which is formed by the International Accounting Standard Board, which are principle-based. At the same time, we have got the US GAAP, the US Generally Accepted Accounting Principles, which is rule-based. So these are the two major things, but I think today the weight is more on the IFRS and on the principle-based standards. Of course, let me again share with you, there is a project going on between IASB and the US FASB, where they're trying to convert the standards. So the standard IFRS 9, the revenue recognition IFRS 15, which is correspondent 115, all those standards are come on a converged basis. One other thing which I want to mention is, as I told you, we don't come out with any standards unilaterally. It goes for public exposure comments. We send it to RBI. To the extent when the or standard corresponding to IFRS 15 was coming in India, it is going to impact the real estate sector substantially. We called all the relevant association of the real estate owner and explained them to what this whole thing is and for the comments. But as we say, none of them bothered at that time, and when the standard came, they cried. That's unfortunately the Indian, I would say. We don't wake up in time, and despite we can say we are taking the horse to the water, but we can't make it drink. So that was as far as the accounting standards took. I was giving the backdrop. Then let's come into the Ind AS story, the journey, how the Ind AS or the Indian standards convert with the IFRS as they're called? What was the history of that? In 2007, the council came out with a white paper saying that ICAI has decided to either converge or adopt with IFRS. That was the first white paper in 2007. Of course, as I told you before that, also we were following the international accounting standards. Then, come 2009, our honorable Prime Minister, the then Prime Minister Manmohan Singh ji, gave a commitment in the G20 that India will converge with IFRS. And 2010, when I joined the council along with Sanjay Agarwal ji, who's the host of this particular program, our honorable president was Amarjit Chopra Sahab, whom Professor Soral mentioned, and he's been again very, very passionate about accounting. That is his core. So under Chopra Sahab leadership, and the chairman of Accounting Standard Board that time was Manoj Fadnis ji, who's going to be one of the speakers in the next session tomorrow or day after. Manoj bhai was the chairman of the Accounting Standards Board, and Chopra Sahab was the president. Within 1 year, we came out with 35 standards, the IFRS converged standards. Fantastic work done. All of us were foot soldiers. Maybe I may have taken up one standard in a group to study it, to give recommendation to the board for discussion, and then going to the council, and from council to the NACAS, and NACAS to the government. But let me tell you, the tremendous work which was done by the whole collective, I would say, council, the Accounting Standards Board, I would respond to the industry and all. We gave all those standards to the government before the deadline. It was going to be notified from 1st of April 2011, and somewhere in February and March we had given. It was notified also before 31st of March, but it was not made mandatory because possibly the industry pressure came in. They were worried what the numbers will look like, and that was deferred. Another thing which we started in 2010, which was not being done at the institute, was we always used to follow the international standards. And as we say, we were never part of the change which we wanted to see in others. We always used to criticize the English is bad, some of the concepts are wrong, etc., etc. So come 2010, when myself, Sanjay bhai, and we are around 9-10 new council members, when we met Chopra sir for the first time, he asked each new council member what his views are. And I suggested to Chopra sahab that why don't we start responding to the exposure drafts at the international level when they come, so that at least our voice starts getting heard. And Chopra sahab immediately agreed, and as luck would have had it, I was made the convener of the group to respond to the exposure drafts. So from that time, we started religiously responding to the exposure drafts. Whatever we read, we feel something is not right, we sort of give the feedback to the IASB. And let me share with you, Soral sahab mentioned, hardly there are 5-6 differences between the IFRS and the Ind AS, and they are not substantial. And in fact, because we decided to stand out, the IASB has itself changed 1 or 2 of the issues which we have flagged off. 1 or 2 issues are still not flagged off, but I think over a period of time. And 1 or 2 are just transitional benefits which were given in the PPE and all. It's not a very major difference, I'm saying. Over a period of time that it will be very immaterial. So this was the backdrop. So as I told you, in 2011, this was deferred. Though we were ready, we gave it to the ministry and to the government. It was deferred by the then government. Come 2014, we had the new government, the NDA government, under the leadership of Prime Minister Narendra Modi. And Arun Jaitley ji, our very respected Arun Jaitley ji, was the finance minister. And he very, very, I don't recollect whether it was in consultation with the institute, but to my knowledge, without consultation, in the 2014 budget, the first budget of this NDA government in July of 2014, he announced that IFRS will be mandatory for listed companies and companies more than 500 crore net worth from 1st of April 2016. So that was the next upstart, that this will be made mandatory. So listed companies and unlisted companies with more than 500 crore net worth from that date, and 1 year later, 1st April 17, companies with more than 250 crore net worth, they were made mandatory. To the banks and insurance companies, this was going to be made mandatory from 1st April 18, but again, because of the trade cycle in which it was and the huge quantum of provisioning which may have required government to provide additional capital to the banks, this was deferred in the banks. In case of insurance companies, the IRD has deferred it because IFRS 4, which was the insurance standard, has got changed, and now it is IFRS 17. And the new IFRS 17 is applicable world over from, I think, 2020 to 23 to the best. It has been revised recently, and it has been differed. So IIT has decided that we'll adopt IFRS because that is the main standard which is applicable to the insurance company. From that particular event, it's applicable to the world and not now. And we don't want to transition IFRS 4 first and then go to IFRS 17 because the change of systems and all what is required. The cost benefit analysis is meant to work out for the insurance companies. So that's the reason they have decided to postpone it to 2022-23. Apart from the Accounting Standard Board, which sort of prepares the standards, exposes it, considers the comments and develops it, there is the Ind AS Interpretation Committee, which was formed earlier when the standards came in to sort out, to help the industry to implement the Ind AS or the IFRS convert standards. And they came out with various clarifications, etc., education material also, which was later on converted to a group, and now it is a group under the Accounting Standards Board. Friends, as I told you, as Professor Koral said, we need to have a lot of R&D. In my view, as I'm reiterating, we have it in our blood to be good accountants, and we need to have a very, very larger role, much larger role in the international standard setting, and which is the dream of the Mr. MP Vijay Kumar also, who's the next speaker and the ASB chairman. And in that direction, as I told you, the initial baby steps were started responding to the exposure drafts, start attending all the meetings which was converged by the IASB and all. And we have created huge visibility in the last 8-10 years. And in that direction, thanks to MP Vijay Kumar, I would say, pointing out, we were able to make Mr. S.B. Zavre, the immediate past chairman of the Accounting Standard Board, as the chairman of the Asia Oceanic Standard Setters Group. Now, these all are advocacy groups. When new standards come, these are the bodies which look at the standards, and it's more like an advocacy group, which works on this. And similarly, I think MP Vijay Kumar also recently joined one of the bodies of the IFRS. But these are, in my view, still baby steps. So to the youngsters who are listening to this program, I would recommend those who are interested in accounting, who feel accounting, and who have got a passion for accounting. Please take this up. We want you to see that you grow in this area. We want you to see that you play a larger part at the International Accounting Standard Board, and how we as Indians can, be more part of the standard rather than just following the standard setting. So that's my dream, and that's the potential which we have in India. With that remarks, I have taken a lot of time, but I would now give it to the Sanjay bhai to sort of take it over and give it to. So this was just a background of the whole accounting standard setting.
Thank you, Nilesh bhai, and you have given a very good brief background. Now I will request Rishabh, my son, to give a small introduction of my beloved friend MP Vijay Kumar.
Welcome, Vijay Kumar sir. It's a great pleasure that you are on our session today. As you do not need any introduction, and I would suggest we could directly move to the session due to the paucity of time, and we would be waiting and to learn from you a lot. Thank you, sir. Over to you, sir.
Yeah, thank you, Rishabh. Thanks, Sanjay, for the invite. And, it was very nice to listen to the past president walking us through the entire journey of the development of accounting profession, in particular to the institute and the efforts at the institute after he joined the council. In fact, they've been quite transformational. In fact, if I have a role to play at the international forum, I think all the credit goes to him for his vision and enabling me to participate there. And good evening to all the members and friends who are attending the webinar today. Extremely happy to interact with you. Personally, would have loved to do a face-to-face program and have the benefit of seeing you all in person. But given the times, I think still having the opportunity of interacting with you itself is a God gift. What I will do is over the next 40 minutes, which is the time given to me, I'll give an overview of Ind AS, which should be an introduction adequate for you for getting a deeper knowledge in tomorrow and day after's technical sessions which have been planned.
Before I get to introduce the topic, I'd just like to make a small disclaimer. I'll leave a copy of this presentation with Sanjay Bhai. In fact, interest of time, I'm not talking much about him, but for me, he's been a mentor, but many may not know, and even maybe past President Nilesh ji may not know, that I got introduced to him sometime in 2007. And that was the time when I did not even know that there was something called Central Council and somebody was a council member and things like that. So it was full credit to his humility that he gave me so much comfort at the time, drove me around when I missed my flight from back to Delhi, and early morning got up and sent me to the airport. In fact, those moments I'll never forget for my life. So this presentation, I'll leave a copy behind. And whatever views I would be sharing over the next 30 to 40 minutes, all of them are my individual views, and none of them should be seen as views of the Council of the Institute of the Chartered Accountants of India or any of the committees or boards of the Council of which I am part of. So this is a fairly exhaustive deck, but interest of time, I will not cover whole of it, but I will definitely address the key aspects which will basically give you good insights which will help you for tomorrow and day after's sessions. In fact, I'm very happy I accepted this invite because most of the participants today here are probably from the teaching fraternity of the various colleges, and teachers inspire, and it's an opportunity to pay respects to them, and that's the reason I primarily accepted this invite to be here today. As far as the journey into Ind AS is concerned, which is fairly important to understand what
MP sir,
yeah.
You have enough time. Please do not worry about the time. Please cover the entire. We have missed some of the points, so I do not want that listeners and participants should deprive of anything. You take full time. There is no limitation. We can go up to 10 p.m.
Oh my goodness! Oh my goodness! Oh my goodness! Okay, fine. I'll do my best. Thank you. Okay, thanks, Sanjay bhai. So Nilesh bhai did give you a good insight on how this evolution happened. In fact, many times history is very important to understand fundamentals, and like every subject, understanding fundamentals is extremely important. It's important because when you understand fundamentals, you actually enjoy the subject. It's almost like a movie, you know, where many of us probably don't see much of English movies, but when you understand a movie, you start enjoying it. So same thing applies here also. Understanding is extremely important. And the government had taken a series of steps for transitioning into Ind AS. It's not like Ind AS came in as if. It was through a collaborative effort between the Institute and MCA that there was a fairly smooth journey. First and foremost, the good number of senior members and faculty members here, they would recall that the format of financial statements, we used to have a Schedule 6 earlier version which almost lived 50 years. And that format of income statement and balance sheet was revised in 2011, when we had the revised Schedule 6. So that particular template of presenting the income statement and balance sheet was basically preparing the Indian corporates to follow the template requirements of the IFRS or Ind AS as we call it. And through the Companies Act 2013, to give more weightage for the accounting standards compliance, there were a few sections which are specifically introduced, which mentioned that the Institute of Chartered Accountants of India, which is a statutory body, as the past president mentioned, is the sole body responsible for formulating accounting standards. So a body has been identified under the new law that this particular statutory body called the Institute of Chartered Accountants of India will carry the responsibility of formulating the accounting standards. Since these standards have to be made binding on the preparers, namely companies, and institute's jurisdiction is only on its members, it is important that these standards have to be notified under the Companies Act. So to enable such notification, the government has a consultative body called National Financial Reporting Authority, whom the government consults before notifying the standards which are formulated by the institute, which is the standard setting body for the country. And given the fact that these standards are largely based on international standards, and the profits which are arrived in the income statement do involve certain amount of estimates, judgments, etc. For taxation purpose, where the objectives of fiscal law is quite different, it was felt that the taxation law, the taxable profit, should not be determined solely by a set of standards which are prepared from a global perspective. The Indian government should have its own lever in terms of determination of the taxable profit. And it is in this context the government felt that they should have a separate set of standards called income computation and disclosure standards, which eventually became part of the taxation law. I'm giving this background just to tell you the extent of preparation and thinking which has gone in before Ind AS became live, as Mr. Nilesh Vikamsey mentioned. After the Honorable Finance Minister then, late Shri Arun Jaitley ji, immediately after taking over the finance minister, said that we will move into Ind AS. And in parallel, to ensure that the smaller companies having net worth less than 250 crores, also have qualitative financial reporting, a project was taken up parallelly to revise those standards. And while that project is still progressing, it was felt that one standard, there was a need for immediate attention, which was the standard on fixed assets, AS 10, and the related standard AS 6 on depreciation. So those two standards were replaced by a new standard, AS 10, property, plant, equipment from 2016. Because this particular standard, there are some fundamental gaps in the erstwhile standard that had to be addressed to ensure that between Ind AS companies and AS companies, there wasn't too much of a gap. Now coming to what constitutes IFRS, and that little bit of understanding is important for us to understand what Ind AS is. The past president talked about the Accounting Standards Board of the Institute having been formed in 1977 and the journey thereafter. But few years prior to that, globally we had this body set up where many countries came together, including India, and formed this body called International Accounting Standards Committee. And this committee had its journey for about 27 to 28 years. And based on the evolution of the standards, it got rechristened as International Accounting Standards Board from 2001. It was the start of the new millennium. And given that fact that there's so much of economic changes which are happening, business changes are happening. So globally, this body also took a fresh avatar in the form of a board. It got rebranded, it got rechristened as International Accounting Standards Board. Till then, the standards issued globally were called International Accounting Standards. And wherever interpretations were required, interpretative guidance was required, those guidances were issued by a standing committee, which were called as Standards Interpretation Committee, and those interpretations have been issued. As the past president mentioned, all of our accounting standards right from 1977, have all had its parentage from the International Accounting Standards and the SIC, except in the context of AS22 on deferred tax, which was based on a practice in UK, which we in India had in the form of guidance note, and it took the form of a standard. And after 2001, the rebranding effort was put in, and the standards got rebranded as International Financial Reporting Standards, and rightly so, because accounting is largely identified as day-to-day maintenance of books of accounts. So when you tell I am accounting, what strikes a person's mind is the day-to-day accounting. But the entire accounting standards, they actually deal with 4 pillars. They deal with recognition, measurement, presentation, disclosure. And all these 4 are to be applied in the context of preparation and presentation of financial statements. So accounting standards are not, I reiterate, not applied in the day-to-day accounting. They are applied only in the preparation and presentation. For example, if you take depreciation, we don't provide depreciation on a daily basis, even though there is wear and tear. It is provided only when you are preparing the financial statement, your balance sheet, income statement, etc. Similarly, entries relating to prepaid expense, outstanding expense, provisions, you don't do that on a daily basis. They're all done only at the time of preparation of financial statement, which is basically for external reporting, for financial reporting. And hence the standards got rebranded, and rightly so, as International Financial Reporting Standards. And since then, every standard which is issued is called as IFRS. And the International Accounting Standards Board took an extremely wise decision that all those standards which are issued up to year 2000, they will continue to have a prefix called IAS 1, 2, 3, International Accounting Standard 1, International Accounting Standard 2, 3 and all. Those standards with the same prefix will now be called as IFRS, and any new standard which is issued will be called IFRS 1, 2, 3. And over a period of time, what were issued as IAS, whenever it is due for an overhaul, they'll be replaced by a new standard which will have the prefix of IFRS. For example, Mr. Vikamsey mentioned about the leases treatment. So for leases, there was an earlier standard called IAS 17, which is part of IFRS. But this particular IAS 17 was replaced a year back with a new standard called IFRS 16. So the old is withdrawn, and the new one, when it comes in, it's called IFRS. So today, as we speak, when someone talks about IFRS, it includes all standards which have the prefix IFRS, and the erstwhile standards which have not yet been withdrawn are having the prefix called IAS, or both of these together constitute IFRS. And the interpretations which are now issued are called as IFRIC, International Financial Reporting Interpretation Committee. Under that, whatever interpretations are given are called IFRS. So all of this collectively represents IFRS. Just to give you a quick understanding of the marriage or convergence between what we have globally as IFRS and what we have in India as Ind AS. So globally, as of January 2020, we have 25 international accounting standards. In fact, it used to be about 40. They were all withdrawn as replacements happened. So with the old prefix, you have 25 standards. And with the new prefix IFRS, you have 16 standards. Effectively, there are 41 technical documents which together are called IFRS, and there are these interpretations. In India we have Ind AS about 39. So corresponding to 41, we have 39 standards. All the 16 new standards which are IFRS we have issued. But as far as the older standards 25 are concerned, 2 of them we have not issued for the following reasons. Our standards are largely in the context of companies, and for non-corporates we have still not brought in equivalent of IFRS. So we have the standard called IAS 26, which is for accounting and reporting by retirement benefit plans. So this standard is not relevant to companies, and hence we have not issued. Similarly, there is a standard called IAS 39. Here again, the past president talked about the equivalent of 39, 32 and IFRS 10, those days which were issued as As 30, 31, 32 as recommendatory. That particular standard IAS 39 was not issued in India because we directly moved to the upgraded version of IAS 39, which is IFRS 9. So globally, many countries who were following IFRS in the past, they were all living on IAS 39, and they moved to IFRS 9 later. But we in India choose, instead of going to a path of first 39 and then IFRS 9, we decided to move directly to the upgraded version, which is IFRS 9. And all the relevant interpretations are all part of Ind AS as an annexure. This is a very important slide, and probably amongst all of the content I'll be speaking, I'll spend substantial part of my time on this slide, which looks so small. Between accounting standards, which have been issued by Institute over a period of time, and for companies, we have this Companies Accounting Standard Rules 2006. And the standards are followed by companies having net worth below 250 crores. And since banks and insurance companies have not yet embraced Ind AS, the banks and insurance companies are all following what is called AS. And for non-corporates, mutual funds, trust, partnership, and all, we all follow only accounting standards. One important point to take note is there is a general impression that non-corporates means small. It is not true. There are many non-corporates which are actually bigger than even companies. For example, an organization like Airport Authority of India has a 40,000 crore balance sheet. And that particular organization, it is not a company and it follows accounting standard. Whereas Ind AS, companies having even balance sheet size of 1,000 crores follow. So it's very important to understand that while we have AS and Ind AS, which is based on IFRS, it's important that we should not have significant differences between the two. And that's exactly what the Institute and the Ministry of Corporate Affairs have done. So between accounting standards and Ind AS or IFRS, Ind AS and IFRS, permit me to use those expressions interchangeably. There are literally no differences except three. One is higher emphasis of substance over form. Substance over form is there in accounting standards. It is there in Ind AS, IFRS also, but there is a higher emphasis. Similarly, fair value. Fair value is there in accounting standards. It is there in IFRS also, but there is a higher emphasis. Disclosures exist in accounting standards, but in IFRS there are higher amount of disclosures. So I'll give some examples on all the three. and I'll spend a little more time on fair value in particular, because many have lots of perceptions or myth or inappropriate understanding around fair value. So I'll spend some time on that. First and foremost, as far as substance over form is concerned, a very simple example which probably has been socialized amongst all the participants here is the example relating to preference share capital. Indian law, preference share capital is compulsorily redeemable in 20 years. For accounting standards, we treat it as part of share capital. But for IFRS and Ind AS, because it is a repayable amount, anything which is repayable is a liability. Even for all of us personally, anything you know that you have to pay it at some point in time, whether it's 3 years from now or 30 years from now, it is a liability. So in form, legally you can call it share capital, but the substance is, it is a repayable amount. Consequently, it is treated as a debt, as a liability. But let me give a little sophisticated example on substance or form. Let's take a very simple example. Let's take a very simple example where there's a company X Limited having a shareholders funds of 500 crores. This company is expanding, so geographically expanding. So it puts up a new factory as a branch setup, So this branch setup, there is a asset liability at the branch, there is income expense at the branch. End of the year, all the asset liability income expense of the branch is added to the head office balances, and you prepare one single set of financial statements. But let's assume the same X Limited, same 500 crore shareholders funds, the expansion happens by setting up that operation as a 100% subsidiary. So 500 crore shareholders funds, 100 crores of money is put in that subsidiary for setting up that new factory. So legal form, it is a separate entity, and in my balance sheet, it is an investment. But that particular subsidiary is controlled by X Limited. All of the decision making relating to that subsidiary is decided by X Limited. And the economic outcome of that subsidiary, profit loss, affects the parent entity. So whether you call it as a branch or a subsidiary, legal form is different, but in substance, both are one and the same. So what IFRS or Ind AS says is look. It says look. In substance, it is one and the same. You choose to have it in a particular form. It is your choice how you want to govern and all. But in substance, for X Limited shareholders, the 500 crores capital which they provided, that entity also belongs to them. So when financial statements are prepared for X Limited, the X Limited balance sheet should include assets and liabilities of the subsidiary, income and expense of subsidiary, exactly the same way as the branch operations are added. And it is on this basis that the whole literature of IFRS and Ind AS is prepared. So it's very important to have this clarity, because when you apply the Ind AS across, you should read the principles from a consolidated financial statements perspective and not from standalone entities perspective. So between AS and Ind AS, the first of the significant changes is a higher emphasis on the concept of substance or form. Each of us here know substance or form, but in IFRS, there is a little higher emphasis, and rightly so. Second, on fair value. as I said a little while ago, I'll spend a reasonable amount of time on this. There is this huge myth or understanding that fair values come into accounting, etc., because of Ind AS. It isn't true. It isn't true. In accounting standards, as we have practiced in India for 40 years, there is enough of fair value elements already there in accounting standards, which are followed by even non-corporate. For example, Accounting Standard 13 requires investments to be classified as current investments and long-term investments. It's a very tiny standard. And this standard says current investment should be valued at lower of cost and fair value. AS 13 uses the word fair value. Many have the impression that it is market value. No. AS 13 says market value is an evidence of fair value, but your accounting policy is lower of cost and fair value. Similarly, in lease accounting, AS 9, in lessee books, when you account lease asset and lease liability, finance leases, you have to record only at fair value or the present value of MLP if it is lesser. There are similar other examples like AS 11, foreign exchange, receivables, payables. Balance sheet date, you have to do mark to market, which means you have to bring it to your market value, which is your fair value, and gains or losses recognized in income statement. And India has been doing it. India has been doing it, including non-corporates. Similarly, AS 15 on actuarial valuation. That is nothing but a fair value of a liability. So like this, there are several examples. So fair value has not come into India because of Ind AS or IFRS. It existed enough in accounting standards, and rightly so. But in Ind AS, you have a little higher emphasis on the same. Why that higher emphasis? Let me give you some examples. The financial statements are meant for the users. It's not for the preparer. It's basically for users, investors, lenders, and other stakeholders. It's basically meant for them. In fact, there is a category called primary users. Primary users are actually the investors and lenders. It is basically meant for them. Put yourself in the position of an investor, somebody who is putting money. Now, when you show something at historical cost, which is a 20-year-old cost, 30-year-old cost, for you who is an investor, what value does it add to you? If I am serving you food, that food should be something you can eat. It should be something of use to you. I serve something which is not useful to you. How is it going to help? So I give you a financial statement which says, this land was purchased 20 years back, plant and machinery 15 years back, and that is a historical cost. That particular historical cost has no relevance to the user. He wants to know what is the worth of this asset today. In the absence of that information, the investor starts speculating. Somebody speculates that probably the worth of the assets is 2 times the book value. Somebody speculates 3 times, and you actually are creating more damage to investors and public money instead of having a very objective approach or a near objective approach of arriving at fair value. So times have changed where people would like to know what's happening now. And take it from me, friends, in the presentation today, in the webinar today. Today, as far as investors are concerned, they are telling, I don't even want this. They are all telling that I want to know what is tomorrow. Because when I invest money or decide whether to stay invested or not, I am not taking decision based on what is the value today. I am taking decision based on what is likely to be the value tomorrow. I want that ability of financial statements to help me forecast. So in this kind of an era, historical cost relevance is the question mark. Now, as far as fair value is concerned, it is not that IFRS or Ind AS requires you to measure everything at fair value. It doesn't say so. In fact, your property, plant, equipment, that is fixed assets, you can continue to carry at historic cost. Nobody asks you. IFRS allows that. Inventory is at historic cost. Receivables is at historic cost. It's just that if you have investments, and if these investments are investments which you are using for trading, where your intent itself is to gain by the value changes, then let the user know that what is the value change. If you invested 100 rupees in a share and it has become 75, let the user know. If it has become 110, let the user know. So let that value change be captured, because your purpose of investment itself was to have that value difference. Those cases to tell that I will show at cost only, that's not appropriate, because you are not making a truthful presentation. In fact, on accounting, I keep saying these two important lines. Accounting is all about staying accountable. Second, accounting is communication. The financial reporting is a communication. Just as all of us here individually in our personal life will expect the people who communicate to us to communicate completely and truthfully, the same expectation is there for the people who use financial statements. The communication has to be truthful and it has to be complete. Now, on fair value, the standards do not force you towards that, but there are principles which allow you that alternative. For example, property, plant, equipment, fixed assets. The standard allows you to follow what is called revaluation model, where you measure your assets periodically at what is today's value. Now, when you do that revaluation model, look at the benefits of that. Globally, it's still not followed. In India, value determinations are still not objective. So all of us still follow historic cost. But let me place before you what this revaluation model is all about. So when the assets are revalued in an inflationary economy like ours, the carrying amount of 100 may become 130. But that 30 rupee gain cannot be included in your income statement. You cannot show it as profit. You cannot distribute dividend. That 30 is shown separately as a reserve. Look at it from user's point of view. He knows that this asset is worth 130. Earlier he was thinking 100, I don't know how much it is. But look at the second important element, which is a very, very important element. I was providing depreciation based on 100. Now, because it is 130, I have to provide depreciation on 130, which means the amount of depreciation to your P&L will be higher. And on depreciation, all of us here know one of the main purposes of providing depreciation is to hold back profits and to use it for replacement. If I provide depreciation based on 100, end of life of the asset, the total depreciation is 100, but the replacement cost of the asset is 130, 140, I don't have money. Consequently, organization suffers. We call it as capital maintenance. The capital actually shrinks. But if I follow a revaluation model, I have consistently provided higher depreciation, which means I held back higher amount of profits. I have not distributed outside. I have held it back, and that profits held back will help me at the time of replacement, because in this model, my total accumulated depreciation is 130, and it helps me to replace the asset without need for additional capital for replacing the asset and maintaining the same capacity. That's the second aspect. Let me give you a very important third element. If you look at income statement, P&L, we are all familiar about this matching concept. P&L is basically a function of matching concept. Income, expenses are matched, and you have a net profit. Income for the 12 months, expense for the 12 months, relating to that income and the profit. Now, income is based on price levels during the recent 12 months. I'm sure all of us are aware about price levels. So based on the current price levels, inflation and all, it's based on recent 12-month price levels. If you look at cost, material cost, I purchased during the 12 months, that is also based on the recent 12 months price level. So both are matching. Employee cost, etc., SG&A, all the selling general administrative expense, they're all incurred during the 12 months, and that is also based on the same price level. But look at depreciation, which is a substantial cost in an income statement. Depreciation on plant and machinery. Depreciation is consumption of an asset for producing. Depreciation is a cost, like material cost, which is part of your total cost. Labor cost is part of total cost. Depreciation is also a cost, part of the total cost. Depreciation is nothing but consuming an asset for producing something. This depreciation is based on some old price levels. Assets bought 4 years back, 7 years back, 15 years back. So if you look at the matching concept, income is in recent 12 months price level, materials is in recent 12-month price level, labor is in recent 12-month price level, but depreciation is some old price level. So because of this, what happens is organizations run a risk of thinking that they actually made a higher profit. Organizations run a risk where they may underprice their products because they have not taken the current cost of consumption. For those who are familiar with inflation accounting, we have this beautiful method in inflation accounting called current cost accounting method. So you need to take it at today's value and then hold back the profit, which can be used for capital maintenance, etc. That is fair value. So fair value existed in the AS. It is there in Ind AS IFRS, but it's not like IFRS is forcing you to do it. It gives you a choice to follow cost almost everywhere. But when it comes to financial instruments, if the intent of your activity by nature itself is to hold it for profit making, you need to obviously report it. And let's understand, the central bank of our country, which all of us hold in very high esteem, the Reserve Bank, has this IRAC norms, which is the income recognition norms, asset classification norms, which RBI has issued way back in 2000 and amended over time. In that RBI IRAC norms, the investments are classified as held for trading, held to maturity, available for sale. So it's not that we have imported this principle from somewhere. We had those principles in some form. They are taking a little better form through this IFRS. Lastly, coming to extensive disclosures. I saw someone making a chat observation that we are on the same slide. I am in the same slide and I'm not moving the slide. As I told, this is the core slide because many have this myth around this IFRS, and it's important I remove that so that when you have those technical sessions tomorrow, day after, there's a good understanding. Now coming to extensive disclosures. As far as financial statements are concerned, the past president gave those examples of, before AS22 came, we called companies as having true and fair. After AS22 also true and fair. Before that, there was substantial reduction in the profit was there, but once AS22 came, there was a substantial change in the profits. There also we call it true and fair. What is important to understand is that financial statements by its nature have significant amount of estimates, judgments which are involved. In financial statements, it's very important to realize that they are not statement of actual position, they are statement of estimates and judgments to represent something closer to actuals. That's where the professional skills and expertise becomes very, very important. Why there are accounting failures and why there are audit failures is because it requires that bit of experience to come to those judgments and estimates. Let's take the case of a balance sheet. Giving this example. If you take asset side, property, plant, equipment, fixed assets are carried less depreciation. Depreciation is an estimate. The life of the asset you estimate, residual value estimate, everything is an estimate. Investments, lower of cost and that's an estimate, fair value. Inventory, lower of cost and NRV. NRV is an estimate. Receivables, less provision for bad debts is an estimate. And if I were to come towards the liability side, your provision for taxation computation is also an estimate based on your understanding and interpretation of tax laws and the consequent impact to you. It's an estimate. Provision for retirement benefits is an estimate. So, and provision for warranties, all of these are estimates. And if you take asset side, even cash is an estimate. Cash held in foreign currency, when you translate, it's an estimate. So when you have so much of estimates and judgments which are involved, and the preparer has applied all of that in preparing, it is important that the user should know. As a user, I should know what kind of estimates you have followed in arriving at this particular figure. For example, if I were to take gratuity liability, it is nothing but the future outflow which I am likely to have discounted to today. If I discount at 8.5%, I get 10 crores. If I discount at 7.5%, I'll get 8.75 crores. So the discount rate will change that figure from 10 crore to 8.75 crores. So the user should know what discount rate I have applied. And the user will convince himself it was a correct rate, not a correct rate, or if he has to make sensitivity, he will make that change. So given the fact that financial statements involve so much of judgments and estimates, which have all gone into the preparation which the preparer knows, you cannot have an arbitrage of information where preparer knows and the investor doesn't know. So preparer, principal shareholder, management, employees because of ESOP, some category of shareholders know and the others don't know. That arbitrage is not to be there. And for this, you need to have those kind of disclosures. And given the fact that there's so much of institutional investment coming in, all of them do require that kind of disclosures. That is why in IFRS or Ind AS, we have those extensive disclosures. There is a member who has been prompting me to change the slide. So for his benefit, I've changed the slide. So this is a slide which is about the IFRS global position. The past president talked about globally two popular frameworks. One is in US, which you have the US GAAP, and almost the rest of the world follows IFRS. And I would like to highlight additionally to all of you that in US, the foreign companies who are listed in US, like there are many Indian companies listed in US, there are Chinese companies listed in US, European companies listed in US, all those companies, the US law SEC, Securities Exchange Commission, allows reporting in IFRS. So while US has US GAAP, for the same US capital market, IFRS is allowed in the jurisdiction right from 2008. So we are following a literature which is a globally accepted literature, including in US. 144 of 166 jurisdictions use IFRS. This is the stats from the ISB website, which is a little dated one, but it's almost the same now. And among the G20 countries, 15 of the 20 countries follow IFRS. The remaining 5 are US, the remaining 5 G20, US, which allows IFRS. India follows Ind AS, which is same as IFRS, but we are not treated as IFRS compliant. They are literally the same as past president mentioned, but we are not counted as IFRS compliant. The same is true with China as well. So these remaining 5 G20 countries also in some form have IFRS, but they're not counted because we do not follow the IFRS brand as it is. There have been some edits here and there. And then there are the standards called IFRS for SMEs, which is for the entities where there's less public interest or no public interest, to be more precise. And 47% of the GDP, global GDP, follows IFRS. It's 47% because it is so much skewed in favor of US and China. So if you take out US and China, it's like almost the whole global GDP actually follows IFRS. In fact, the 53% includes US, includes China, includes India. 3 large GDPs. Among the top 6, we have last 3. And among the 3, we all know how big is China and US. So that's how it looks like 53%. But effectively, India also follows IFRS, China also follows IFRS, and US allows IFRS. So in that sense, it's much larger. So in India, the journey of moving to IFRS, the past president gave this direction, but I'll just spend a minute on the global standard setting process. I think it's important to have a clarity on this. Globally, we have accounting standards for private sector and for government sector. Government sector, we have a set of standards called IPSAS, which is the International Public Accounting Standards, Public Sector Accounting Standards called IPSAS. And these standards are all issued by IFAC, which is it's a global body where all the professional accounting organizations are members. So IPSAS are issued by IFAC, but all the IPSAS are based on IFRS. And in India, the institute, our institute, issues standards for local bodies, which are all based on IPSAS. As far as private sector is concerned, we have IFRS and US GAAP, what the past president had mentioned, and this is how the structure is. And in India, this is the journey which we have discussed. And a few jurisdictions have decided that they will not follow IFRS as it is. Instead, they will converge. India is one of such jurisdictions, and rightly so. Most countries have decided to follow IFRS as it is. And if you look at our neighboring countries, Bhutan, Nepal, Pakistan, Sri Lanka, and rest of the other countries, European countries, everybody, they have adopted IFRS as it is. But India has significant accounting capabilities. In fact, I was very happy to hear Mr. Grewal's name being mentioned in the inaugural address. In fact, people like me and many of us here, for all of us, accounting was all about Mr. T.S. Grewal. You know, it was all about him. We never had the opportunity of seeing him or know about him, but it is his book which actually helped us to know what this subject is. And today what we are, we owe it entirely to that legendary person and pray for him to bless us from a heavenly abode. So in India, we decided that for different reasons, we will converge. And I'll just read out a very important sentence, which is part of the white paper, which the past president mentioned, and which was endorsed by the Ministry of Corporate Affairs. What constitutes convergence is to design and maintain the national accounting standards in India in such a way that the financial statements which are prepared in accordance with national accounting standards can draw an unreserved statement of compliance with IFRS. So this is what is meant by convergence, and this is what was signed off by the Institute of Chartered Accountants of India and Ministry of Corporate Affairs. As we speak today, we have achieved the first 3 lines of this statement. The last one, which will help us to draw an unreserved statement of compliance with IFRS, is a little distant now because we have what are called carve-outs. I'll spend a little time on carve-outs. And it was important that India should have carve-outs, otherwise it would not have been practical to move to this particular gap, which is Ind AS. So probably sometime in future, I am sure there are many younger members who are listening here, and all of them will definitely get the benefit of saying that Ind AS financial statements are the same as IFRS. We are not far away. We are probably that small distant. I saw just one post flashing. What is meant by unreserved statement of compliance with IFRS? What it means is when you prepare your financial statements as per Ind AS, you should be able to tell that this financial statement is equal to IFRS. Today, we cannot say that because the Ind AS has some carve-outs, and because of the carve-outs, International Accounting Standards Board does not recognize Ind AS as being equivalent to IFRS. So we have the very, very small carve-outs, but it is essential for transition. But I'm sure going forward sometime in future, we will be able to make this statement. In fact, before I started speaking in the chat box, I saw probably one member was saying, what is the benefit of learning Ind AS, or how do I benefit from learning Ind AS? All that I can say is every commerce student or commerce professional eventually may end up as an accountant or an auditor or a treasury manager or as an equity investor or as a research analyst or as an investment banker. No matter what career you end up with, including as an entrepreneur, everybody is going to deal with financial statements. And all your decision making, whether you are going to take decision as an investment banker or as an equity research analyst or as a treasury head, whatever be the role, or as an auditor or as a preparer, whatever, everything will be around financial statements, or even as a tax consultant, tax expert. So even a direct tax practitioner, for him, and I know Sanjay Agarwal ji, he knows the subject fairly deeply. He is known as acknowledged tax expert and he knows the subject fairly deeply. It's very important that a tax expert should know accounting well, because the amount, the taxable income determination or the tax treatment is a function of how you have accounted. So there's so much of correlation which is there, and somebody cannot become a tax expert without understanding accounting well. So in that sense, given the direction of Ind AS will be the financial statements, and all the accounting standards are also going to get revised to get closer to Ind AS, it's important that every young professional should know what this Ind AS is all about. Now, let me just highlight a couple of important ones which we can take pride as a nation. The past president did talk about standard on revenue, IFRS 15, Ind AS 115. I just want to highlight there that as a country, India was prepared to implement Ind AS 115 1 year ahead of the rest of the world. But internationally, since the standard got deferred, we also deferred the same. But corporate India and the Indian auditing fraternity was ready to embrace that standard. And the most complex of the standards, IFRS 9, internationally it got deferred multiple times and eventually it hit the road in 2018. But India followed the standard. I repeat, India followed the standard from April 2015 onwards. Solid 2.5 years ahead of the rest of the world. The advantage is we could develop a pool of accounting professionals with hands-on experience who are sought after by the other countries who are looking at implementing IFRS 9. So those were the kind of forward-thinking steps which the institute and the government had taken. So as far as India is concerned, there is contribution happening towards standard setting, but there is also this development of capabilities around the accounting. And you might be aware that government has listed about 12 sectors as high priority sectors for export of services. One of them is the accounting service. And we know in India the number of BPOs who are operating and employing almost a few 100,000 of people. And that's all dollar revenue which is being earned. And how is all that happening? It's happening because there is that accounting knowledge which has got developed in the country. Now, as far as Ind AS is concerned, while you will be going through this tomorrow and day after in fair amount of detail, and I'll leave the slide deck behind. Interest of time, I'll not go through individual points, but I'll give you a flavor of this. Many would have this tendency to tell that Ind AS is very heavy, it is complex, IFRS is heavy. Ind AS and IFRS are interchangeable expressions, both are the same. Let me share with you that Ind AS is simple as long as your nature of transactions are simple. Only when the transaction is complex, you require a detailed guidance to ensure that there is uniformity in accounting practice and the user of financial statement knows what is the correct position of the profit of the organization, etc., etc. I'll give you very simple examples. If somebody wants to make a sale of goods without any warranty, I just sell a product, 100 rupees, I sell a product. I need not even read an accounting standard. Sale of product, 100 rupees, you can recognize as income. But if the same product, I sell it along with a 3-year warranty, and I undertake an obligation that anything happens to product in next 3 years, I'll replace it. So those cases, my sale invoice is 100 rupees, but as an organization, I've taken an obligation. Income is now, but I have an obligation to repair anything which might come in the next 3 years. So those cases, based on the number of units sold and the probability of how much damages, how much repairs, how much replacement, I have to necessarily measure the amount of provision I have to make for meeting those obligations. Otherwise, you will have income in this year and you'll have expense in later year. Matching concept will not be there. So those cases, guidance is required. That is why standards become complex. They are not complex because the standard setter wants to do it. They're complex because the business transactions are getting more and more customized and complex and based on the customer requirements. Take another very simple example. And this is an example which is applicable even for tiny organization, very small proprietary shop. I'll give you a personal experience. About a year back, I had to buy some reading glasses for my daughter in a small glasses showroom, a spectacle showroom. The glasses were sold for 900 rupees, that spectacle frame or whatever is 900 rupees. But before I could go and invoice it, the person says, if you buy for 1,000 rupees, you will get one more frame, which you can use it later, or you can use it interchangeably depending on the dress you wear and things like that, different color or whatever. And the salesperson went one step forward and said, you need not buy this now. You can buy it later as well. Within the next 1 month, 1 year, if you come, you'll get a 50% off. So instead of 900, you buy for 1,000 rupees, but you will get a loyalty right to buy another frame, either now or anytime in the next 12 months, whenever you change your mind. And I'm talking about a small dukandar. And that person knows that having sold that extra 100 rupees is not his income now. That 100 is a cost for the loyalty which he has given, loyalty right he has given to somebody else. So like this, all business transactions, wherever they start getting complex, there is accounting guidance. That's why it is voluminous. As long as transactions are simple, and I'm sure there are very well-learned professors here who have taught for 30, 40 years. They would all recollect that 20, 30 years back, you wouldn't have these kind of transactions. Life was so simple, accounting was simple. But now transactions have become complex, and this complexity is resulting in financial statements not capturing the profits correctly. And unless you give that extent of guidance and mandate it, you will not be able to have the right kind of profit for people to take qualitative decisions. So these are a few slides around the same theme, and I'm sure you'll be able to connect. So accounting standards and timelines. The first of the accounting standards was issued in 1979. It's almost a good 40 years since we had these standards. And up to 1994, we had 15 standards. Then a whole lot of standards got issued up to 2003. Thereafter, we took a decision to converge with the international accounting standards, and here we are. Happy to state that almost all the public interest entities have moved to Ind AS, and my sincere thanks to the whole accounting fraternity, both preparers and auditors, who have helped a seamless embracement of Ind AS. In fact, anything new comes. In fact, if you look at the last 10 years, we had a new Companies Act, we had a new indirect tax in the form of GST, we had insolvency law, real estate law, etc. Everything new had some high decibel discussions. But as far as Ind AS is concerned, it got so smoothly embraced, and complete thanks to the accounting fraternity and auditing fraternity who have helped this. And at the institute, we have been gifted with senior council members like Sanjay Bhai, Nilesh Bhai and all, who have been through the 2010 to 2015 in developing all the necessary guidance which was required for members to do this. What is left out now is the banks and insurance companies. There are some legal issues for them to adopt. Without much details into that, the concerned regulators are keen that banks and insurance companies who are public interest entities should move to Ind AS. So it's a matter of time before it happens. Hopefully it will happen in the next 2-3 years. And with that, almost all the public interest entities in the country would have been under this framework. So coming to the standard setting process, I saw this beautiful organization called Indian Accounting Association, and I'd like to make a appeal to that organization and to all the teachers who are attending this session today. As the past president, Mr. Vikamsey, said, the standard setting is a fairly engaged process. We have members from industry, members from CBDT, etc., and we have members from academia. But it's still a smaller body. We want more wider consultation. So whenever we issue what are called exposure drafts, I would request you to use within the faculty resources and also the students who are in the third year of BCom or doing post-graduation to do some research and give us comments on those exposure drafts. India's stature globally will increase, and we will create opportunities for the next generation of our students globally if we can contribute to more standard setting internationally. We are certainly doing, but there is scope for much higher contribution. So if we can have bodies like the Indian Accounting Association and the faculties who have so sound conceptual knowledge, use the benefit of the students' time for research and help us in the exposure drafts, we will definitely be able to do a much more better the job than what we are currently doing. On Ind AS, I just want to set a little bit of expectations before I come to some technical provisions. I'll just use 2 slides. There are some 6-7 slides, but I'll use 2 slides. There is this general impression that once you move to Ind AS, the profits will reduce, the shareholders' fund equity will reduce. There is that impression. And I see many forums where people tell companies who were in Germany, Mercedes-Benz, got listed in US, and when they prepared, the profits came down and things like that. While it's good to have those examples, I want to be a little more pragmatic. When you move from accounting standards to Ind AS, the impact on profits, revenue figure, or shareholders' funds will be a combination of how you are historically accounted, what kind of M&A transactions, business combinations, mergers and acquisitions you have had in the past, and the choice of accounting choices at the time of Ind AS transition. Those are very critical. I'll just share with you from public domain. These are some 4-year-old figures, but they are relevant to help you understand. Let me take 2 manufacturing companies, one Tata Motors and Dr. Reddy's, who prepare financial statements as per IGAAP, which is accounting standards, not Ind AS, and IFRS, which is the Ind AS, and they prepare this because they are listed in US, both Tata Motors and Dr. Reddy's. On revenue, for Tata Motors, the impact is revenue reduces by 270 crores on a revenue base of 2,62,000 crores. For Dr. Reddy's, the revenue actually goes up by 116 crores. For Tata Motors, the net profit is lower by 1,157 crores. And for Dr. Reddy's, it is lower by 124 crores. Shareholders' funds, for Tata Motors, it's less by 2,800 crores. And for Dr. Reddy's, it is actually higher. So it keeps changing. So you cannot come to a singular view that because of IFRS, between AS and IFRS, the net profit will definitely move in this direction or shareholders' funds in that. That kind of inference is just not possible. I'll take 2 companies who are in the same industry, Infosys and Wipro. Figures as per IGAP, which is accounting standards, not Ind AS, and as per IFRS, which is Ind AS. So revenue figure for Infosys is higher in IFRS. For Wipro, it is almost the same figure. For Infosys, net profit is higher by 115 crores on a profit base of 12,000 crores. For Wipro, hardly any difference. And for net profit, net worth, it is about 5,000 crores higher, and for Wipro, it's 3,800 crores higher. So you cannot come to a conclusion that between AS and Ind AS or IFRS, that the accounting standards were very weak, and because of Ind AS quality it will better. It's not necessarily so. It's a combination of so many other factors, like historically how some accounting choices were made, the extent of mergers and acquisitions which they have done, and the methods which were all followed. Now, I'll skip these slides, which are all the impact studies. And for those who are interested to learn more, at the institute, we had a group called Ind AS Transition Facilitation Group, which was again rechristened as Ind AS Technical Facilitation Group. On the various Ind AS issues have been identified, and guidance has been given in those, which are all available as part of the website, and some education materials have also been issued, including on the recent standards. So let me now come to the technical part of the presentation, maybe some 4 or 5 slides here, which basically talk about some accounting aspects which are covered in Ind AS or IFRS, which we don't have in AS. And AS is now getting revised so that we get closer to Ind AS. It is very important because if these two are not closer, what will happen is, today I am a 200 crore equity company, shareholders funds company. After 3 years, when I become a 250 crore net worth company, and when I move to Ind AS, and suddenly if you find that the quality of accounting, if you find that the profit is reducing in Ind AS, or the accounting values are different, then people's confidence in accounting standards will completely go away. So it's very important that both should be almost the same, except that given that these are lesser public interest entities, we should have lower disclosure and make life a little simpler, but we cannot have different principles. So let me highlight a few important elements which are there in Ind AS, and I'm sure the faculties would be dealing with them tomorrow and day after. And I know there's one Kamal Garg who is going to address. He is also a member of the Accounting Standards Board and a big asset to the board in terms of his contribution and the kind of technical knowledge he brings to us. Ind AS 8, accounting policy, change and prior period items. As far as Ind AS is concerned, whenever you make an accounting policy change, while you would do the change in the current year, all of us know one of the fundamental characteristics of financial statements is comparability. In fact, for all of us here in the call or in the webinar, by nature, whether it is a student or otherwise, it's very natural that you start comparing. I got so many marks now. How much did I get previous time? I got so many marks now. How much did he or she get? So my marks of 95 does not have a meaning unless I compare it with another. The other person got 90, my 95, I start becoming happy. The other guy got 97, my 95 looks smaller, I lose a little bit of my happiness. So that number gets life on comparability, intra-firm and inter-firm. So it's extremely important that we should have this comparability. So in Ind AS, whenever you do accounting policy change, you have to apply it for the previous reporting period also which you are reporting. So if I was valuing inventory in FIFO earlier, now I moved to weighted average. The previous year financial statement also I should restate so that I can look at like to like how there it is. And there's a concept of a third balance sheet, which is the opening balance sheet to be done. Similarly, as far as taxation is concerned, interest of time, I'll not go individually through each of them. I'll pick and choose some of the major items. Ind AS 12 taxation is concerned. For deferred taxes, past president mentioned that we did not follow the international approach. So for accounting standards, we follow what is called P&L approach or income statement approach. Whereas for Ind AS, we follow balance sheet approach. The reason is in AS, all items of income, expense, gain, revenue, everything goes and sits only in the P&L. Whereas in Ind AS or in IFRS, some of the items of income expense, they go and sit in what is called other comprehensive income or directly in the balance sheet. We all know dual entry concept, dual aspect concept. If there's an income, it affects your balance sheet. Expense, it affects your balance. So everything has that impact. So when you take some items of your income, expense, profit, loss into other comprehensive income, other parts of balance sheet, the only way you can assess your taxation impact for the future is on the balance sheet approach. Because in AS, everything came into income statement. But in IFRS, it goes into 3 different places. But what is common is the balance sheet. So the way you can compare and identify is only the balance sheet approach. And as far as the business combinations are concerned, mergers and acquisition, for AS, we have the accounting standard 14, which allows pooling of interest method, purchase method and all. But internationally, and in IFRS and Ind AS, we don't have a pooling of interest method except for what we call common control transactions. I'll explain why. And rightly so. Whenever somebody is acquiring a business, you are paying consideration to the other person based on what is the worth of the business, not based on book value. Book value may be 100, but the worth of the business is 150. So I pay consideration of 150. So when I pay a consideration of 150 and I account assets at 100, you are making a misrepresentation. So in purchase method, what is called acquisition method, we have to account for the assets at the value for which I paid for them. So I paid 150. So I should record the assets also at the fair values. My consideration is based on fair value. And I paid fair value because my assets, I am looking at them at fair value. So I need to record those assets also at fair value. And consequently, there is no book value method of accounting. Similarly, when we come to consolidation also, same logic applies. I pay a consideration of 150. For consolidation, I just add line by line 100. The difference 50 is treated as goodwill. That goodwill is a meaningless number because this 150 I paid because the land value is higher than what is there in books. Plant and machinery value is higher than what is there in books. Same is the case with others. And hence, assets and liabilities need to be recorded only at fair value. And goodwill is supposed to be only a residual number. So no pooling of interest method, except in the case of common control transactions. And in common control transactions, this is allowed because let's say I am X Limited and I have 2 subsidiaries, Y and Z. So if Y and Z are coming together, I am the same parent. So I can't make profit on within the group transactions. So those cases, everything is done only from a pooling of interest method. Similarly, as far as intangibles are concerned, there's a very interesting kind of accounting treatment. Now, when it comes to intangibles, you have intangibles like patents, copyrights, trademarks, software and all. You also have goodwill. So there are some intangibles which have a finite life of 8 years, 10 years, 12 years. There are some intangibles which don't have a finite life. Goodwill, brand and all, they can last whatever period they can last. So in accounting standards, we go on the assumption that all intangibles you have to write off within 10-year period. Within 10-year period. Whereas Ind AS 38 says, look, there are some intangibles which have a finite life. You amortize during that life. And intangibles which don't have a specific life, finite life, you test them for impairment annually. Keep checking regularly whether there's a fall in the value of the assets. So that's the impairment treatment or intangible assets treatment. And when it comes to principles of consolidation Ind AS 110, as far as accounting standards are concerned, we follow a very simplistic approach of saying that more than 50% shareholding, majority board of directors, they have very simplistic yardstick. Those cases you treat as subsidiary and consolidate. But in substance, there are many instances where I can have a shareholding of 30% and the shareholders' agreement with the other party is that I will control the organization. So those cases, even with 30% shareholding, I will consolidate it. Balance 70% will be shown as non-controlling interest. So what is important here is again the substance of the transaction. Substance. Similarly, as far as the leases are concerned, very important change. This is a change which has come in the last year. And the Honorable Past President talked about the same, so let me spend time on that. When organizations take assets on a lease, let's say I take office space on lease, I am going to do the interiors. So when I take an office space on lease, the lease agreement is minimum 6 years or 9 years. I will not spend 40, 50 lakhs, 1 crore, 5 crore on interiors, where the lease arrangement is 12 months and the other guy asks me to go out. I will not do that. All that soft furniture is waste. I can't remove and go elsewhere. So what the standard says is, in the case of all these leases of 6 years, 9 years, 5 years, whatever, those leases, I have agreed as a lessee that I will pay you over the next 6-year, 9-year period. And for that, I get the right to use the asset. So the user of financial statement should know that here is an organization who has taken some assets on lease and that assets are being put into use for their earning. This is pretty common in airline industry, retail industry, where they don't own assets, they take them on long-term leases. As far as credit rating agencies are concerned, whenever they do credit rating, before Ind AS 116 came, every time they used to calculate the future liability, reduce it, and then do the credit rating, because it was not captured in the financial statements. Anything which is off balance sheet is high risk. So it could miss attention of user. So in that context, the standard got amended to say that these kind of off balance sheet items, which gives you a right to use an asset for 9 years, and you have an obligation to pay for 9 years, you have to bring it in your balance sheet. Let the readers know, users know, that you are actually having an asset on which you have a right to use it, and you have an obligation which you have to retire it over a period of time. And as far as presentation order is concerned, in Schedule 3 to Companies Act, we have a separate division for Ind AS companies and separate for the other companies. And we have elements which are relatively new for Ind AS, like statement of changes in equity, which is nothing but statement of changes in reserves and surplus. Other comprehensive income is an interesting concept. In the income statement, P&L, there are some items of income which are more of unrealized in nature. For example, actuarial gains and losses. It is unrealized. We all know that as of 31st December 19, if interest rates were in the range of 8 to 9%, now the interest rates have come down by 150 basis points or so. When your interest rate comes down, your liability increases because your present value you're discounting at lower rate. So that differential liability, in accounting standards, we take it to P&L, but it's arising more out of revaluation. So those kind of revaluation items we capture in the statement called other comprehensive income, so that user knows what is the profit because of operation, what is profit because of such revaluation items. Their terminology is called financial assets and financial liabilities. We have a standard specifically deal with what is called investment property, and it's pretty common. If I were to take a place like Delhi, you find DLF all over. And for DLF, all the properties which they're holding and earning rental income are investment properties. Earlier, it used to be dealt with under AS 13. Now we have a specific standard investment property. There are many companies who are into dealing with biological assets, whether it's plantation activities or cattle. So for all of them, we have this standards here. Small nomenclature changes as well are there. Some more impact areas which are there. Just pick up some items which are more relevant or which are more relevant. I think I more or less covered the key items. I think I should leave it to the faculty tomorrow and day after to deal with the technical details and not speak everything. But I just want to share with you this slide on impact. Fair valuation of land and property, plant, equipment. If somebody follows the revaluation model, it will have an impact on the net worth. Fair valuation of financial instruments will have an impact. Deferred taxes, the impact is not too very significant as far as shareholders' funds are concerned, but in the individual P&L it is significant. I'll tell a very interesting concept here. I'll just pause a minute. In accounting standards, suppose I have 2 subsidiaries, associate company and all. When we do consolidation, subsidiaries, we do line by line addition. Taxes are also added up line by line. And equity, we pick up share of profits. Now, in Ind AS, what it says is, the profits of the associate, the undistributed profits, or the subsidiaries, the undistributed profits, eventually those profits you may take it tomorrow. So those profits, when you take it, they'll be subject to tax, either as dividend distribution tax till last year, or now it will be subject to tax in your hands. So that taxation element also you need to include in your overall tax computation for your consolidated financial statements. So those kind of principles have been highlighted. So the sector-wise impact analysis, which is also captured. So with this, let me come to the concluding part, and I'd like to leave the floor open for interaction for certain questions. There was some, I saw some chat box questions on carve-outs and reasons thereof. I'll spend a few minutes on this. Sanjay Bhai gave the freedom of speaking late also. So I'll just use 5-6 minutes and speak on the carve-outs, because many have this debate. Why can't India move fully to IFRS so that we can have unreserved statement of compliance with IFRS? So in 2010, when the convergence project was taken up, there were effectively about 10 carve-outs, but over a period of time, this 10 have become 8. This 10 have become 8, and they're likely to reduce. As far as the carve-outs are concerned, majority of these carve-outs are in the context of transition, and it was very important that India gives this carve-out. Otherwise, for a large developing economy like ours, and a country where you have lots of public sector organizations as well, it will be very difficult to move to Ind AS without these carve-outs. So these carve-outs are largely in the context of transition. I'll just use 2 examples here. One of the examples is regarding fixed assets, property, plant, equipment. What IFRS says is, if you want the stamp of IFRS, you should restate all your property, plant, equipment using the principles of IFRS, which is IAS 16. Or you can restate everything at fair value. What our institute rightly did 2010 and carried it thereafter, we introduced a third option where we said, whatever is your existing book value, you can carry that book value as it is. No need to recalculate the whole thing. That particular option was very important, and almost 95% of the companies have used that option. That itself is a validation that that option was essential. The reason was, if you take the organizations, they have assets which are 15-year-old, 20-year-old, 25-year-old. To go back 10, 15 years and recalculate and reverse some of the accountings which have been done in the past is just not practical, because by law, accounting records you are required to maintain only for 8 years, whereas some of your assets are 15, 20 years old. And for a developing economy like ours, those days, 1970s, 80s, 90s, and we had devaluation of currency also. Exchange differences, you were allowed to add it to the cost of asset. Not a good accounting treatment, but those days it is good, those days it's good. So now to go and identify that figure and undo it is not practical. So the institute knew that these property, plant and equipment will in any case depreciated remaining life of 4 or 5 years. New assets will in any case come as per the new accounting principles, which is the IFRS or Ind AS principles. Let the old one, wherever those differences are there, maybe it constitutes 10% of the value change. Let it get erased over a period of time. And that's how we introduced that carve-out. So that is one material carve-out. And as long as we have this carve-out, we will not be able to have that sentence of unreserved statement of compliance. It's not possible to do it. But are we happy with it? Yes, we are happy with it, because it's a one-time one. And the new accounting professionals, new assets, everything is getting accounted only as per the current accounting practices. And India has demonstrated enough towards its commitment towards the best accounting principles by adopting one of the most complex standards like IFRS 9, 2 years ahead of the rest of the world. What better statement can we have than this? So these kind of carve-outs have been introduced. Another carve-out, I'll give an example. Most likely we will remove this sometime soon, is on Ind AS 103. It's very rare cases or probably situations like this pandemic now, you'll end up with situation where I'll buy a business where I'll pay a consideration of 100, but I will get business worth 105. So you have a situation where I'm receiving something worth 105, but I'm paying only 100. So which means I'm making a profit of 5. That profit of 5 is generally in our mind a capital profit. That's what is in our mind. But the transaction wise, I paid 100, I got 105, 5 is the profit. In IFRS, this 5 goes to P&L. It's called bargain purchase. Your efficiency, you bargained and got it. Not using for dividend, you can have other checks and balances. But in India, we made a carve out and said, we will take it to capital reserve. So if you look at in real life, how many such transactions are there? Difficult to get that kind of transaction. Very rarely you come across it. So these kind of carve outs have been done. Another carve out, which again I'll spend a minute because there were 3-4 people who put in the chat box. In an equity method, where I have associates and I am consolidating, when I pick up equity method, associate is an entity where I am exercising significant influence. I am not controlling it. Somebody else is controlling. Somebody else is controlling. So what IFRS says is the associate profits which I pick up should also be as per the same accounting policies which I am following. So in India, what we said is, look, I am not controlling it. Somebody else is controlling it. Asking that somebody else to calculate profits as per my policies and all is not practical, particularly when you do quarterly financial reporting and all. So we have made that carve out and we have said something very mild. It's not a major one. We have said when it is impracticable, then you use the financial statements as it is. Wherever practical, try to ensure uniformity. Otherwise, it's fine. So we did not make it so imposing. So those kind of very practical elements have been brought in as far as India is concerned. So that's the rationale. This is almost the last slide I have. I'd just like to bring to your attention that globally and eventually in India, we have this IFRS 17, which is likely to be effective from 2023 Jan. Maybe early adoption will be allowed. In India also, we will be issuing the corresponding standard. It should be issued anytime by end of this year. But there's a very important project, and I would request all the teaching faculty members here in particular. There's an exposure draft of the International Accounting Standards Board on primary financial statements. Primary financial statements, this standard is path-breaking. It's transformational. The way the income statement, P&L, will be prepared is far different from the way it is prepared now. The P&L in the proposed exposure draft says that the proposed exposure draft provides that you need to capture your profits in such a way somebody can understand how much is operating profit, how much is profit getting attributed because of your investing activities, etc. So it's a very nice standard which has come up. It's come after research of almost 4 years' time. The exposure draft has been issued internationally, and we have issued it in India as well. And the corresponding Indian standard will come probably a year from now. And there's another interesting project on goodwill impairment, and I would invite people to do research on that. There's a huge global debate happening on whether goodwill, we should follow the impairment testing model every year. People feel it's costly to test every year. Instead of that, should we amortize it over a period of 10 years or whatever? There's a debate happening on this. There's an interesting paper published here. And on this goodwill impairment, conceptually, in fact, I'd just like to take that point which the past president Nilesh Bhai mentioned. Sometimes these concept things are so exciting, like until AS22 came, that profit we were pretty happy. But once that standard came, those profits looked so obscene for us. Without deferred tax, the profit looked like, oh my God, this was the profit I relied on so many years. It was so intriguing. The same is true with goodwill, and I'll give you a nice example on this. And I also want to share with you that from India, we have a chartered accountant who is working as a staff in IASB, and he has contributed to development of IFRS 15. He was the technical staff on that, and he is the same staff who is now working on goodwill impairment as well. I'll just explain this concept. So beautiful one, and it is surprising, and it actually puts us saying that, oh my God, I was doing like this so many years. Let's assume I'm buying another business. I'm acquiring a company. I pay extra consideration of 50. Today, what we do is that excess consideration 50, we identify as goodwill belonging to the acquired unit, cash generating unit acquired. But most cases, what happens is I pay extra 50 because this acquisition which I do, a downstream acquisition or whatever I do, actually helps my existing assets to perform much better. It helps to perform much better. So the extra 50 I pay is not for the unit which I acquire, but it is for making my existing unit to function better. So the goodwill has to be broken up as how much belongs to the existing unit. I'm paying it for acquiring, but I'm paying it because it helps my existing ones to get better. So I need to allocate it to this and then do the goodwill accounting. And there is one other project on macro hedging also, which is happening globally. So thank you all for your patient listening. I did enjoy introducing the topic to you, and my sincere thanks to past presidents for kind words of introduction, and Sanjay Bhai, who's been a mentor, almost like articleship under him for 3 years, more particularly in terms of the approach to work at the institute. Thanks to Sanjay Bhai for the invite and thank you all.
Before we take the question answer, I will request Honorable Past President Nilesh ji to sum up the session, and we have few questions. We will unmute them, and then you will answer, and then finally the formal vote of thanks. Dr. Anil Kumar will do the honors. So
thank you, Sanjay Bhai. Friends, I don't know what to say. The only thing I can tell you is, if you are aware of Ind AS a little bit, you couldn't have got a better presentation. Am I audible? Is my voice coming clearly?
Yes, please go ahead.
Okay. Because there's some buffering I'm seeing on the screen, but that's fine. Thank you. Friends, what I was saying is, you couldn't have got a better presentation on Ind AS. Very simple, very lucid. What are the critical issues involved? Better than what the way my friend MP Vijay Kumar has spoken. And just to sort of sum up, he started with the regulatory changes, what has happened in the past. And here again, I would want to just add one more point. He talked about revised Schedule 6, which came up in 2011, which was the starting point for the, I would say, this particular whole journey. And in this journey, there's an issue of current and non-current, current liability and non-current liability. And that time I was part of the study group which was looking at it. The issue was, in the case of Indian banking system and the way Indian corporates are there, assuming any covenant is broken of the loan agreement, say example, it's a term loan and some documents not given, it's a breach of the loan covenant, the liability, even a term liability, could have become current and the whole balance sheet could have got skewed. So we debated in the study group, then we brought it to the council. Chopra Sahab was the president, and we came out with a guidance note saying that in India, minor aberrations to the covenant in loan agreements will not be treated as current, will continue to remain non-current as non-current. So That is where I'm saying, I'm requesting all the audience, there are 600, 700 people or more in this audience. Please look at the exposure drafts. Please, from your experiential perspective, people who are in industry, the academia, the Indian Accounting Association, the professors who are there, the teachers who are there, and with your experience, please come out with your suggestions so that we can look at it the way we got hold of this current versus non-current in the revised schedule 6 in 2011. Based on the Indian situation, it may not be technically theoretically correct, but we need to give it a slight sort of a carve out, if I can say so, at that point of time. Then MPV mentioned about the Companies Act, ICDS. Then he brought about how the IFRS committee is structured. Initially a committee, then a board, and then he spent time on principles governing the IFRS. Very lucidly, 3 points, very subtle: substance over form, fair value, and extensive disclosure. And all his experience is sort of on those 3 simple matters. The way he sort of articulated was just fantastic. I would request you, after you go through these 2-3 days of session, please relook at this particular session. After you go through the individual, the technical sessions, this video will be available. Sanjay will be providing it. And in a gist, MPV has, sort of brought down the whole Ind AS and IFRS into a whole gist. Then how many jurisdictions have adopted IFRS who are into US GAAP, how many percentage of, entities are there. Then the government accounting, SRCC covered. And the fact that he's so national, it's a pride that we adopted IFRS 9 2.5 years early. And same way, we are ready with 115, even 1 year before the international is going to be adopted. And the factual impact on the companies, whether the manufacturing companies, the technology companies, etc. So that gives us a lot of insight in a very subtle manner. And then the impact on changes, as the accounting policy change, the subtle differences, the dividend, the business combination, the preference capital, the service concession agreements, the intangible impairment, control, how it is defined currently and how it is defined in the Ind AS for the consolidation purpose, the revenue recognition, leasing, and very subtly bringing on the carve-outs. As you rightly said, they're not substantial, mainly this transitional carve-outs, except barring 1 or 2. And if I would sum it up, Sanjay bhai and all the audience who's present there, Dr. Anil Kumar and all the participants on your behalf, what I like best of MPV, apart from the technical, the whole presentation, is his 2 statement. Accounting is all about being accountable. Accounting is all about communication. Communication meaning truthful and complete. I think if you imbibe that in your life, I think success will be yours. I think nobody can stop you from a success. Accounting is all about saying you be accountable, you have good communication, truthful and complete communication. I think nothing in life will stop you. You'll be successful in any area of walk of life you'll take up. With this, I want to sum it up and throw it open to the questions. I've taken earlier the 15 minutes, 10 minutes earlier I've taken up. I spoke more early, so I won't take more time. Let's get into the Q&A session.
We are unmuting now Mr. Kulshetra. Please ask your question, Mr. Kulshetra.
So, sir, basically in regard to the revaluation of assets, so I would like to know, so why the culture of revaluation is not so promoted globally, and also what would be the treatment of the cost involved in the revaluation of assets?
MP sir?
Yeah, I'll answer. As far as the expenses relating to revaluation, you're basically relating to the valuer's fees and things like that. They would obviously be part of your income statement. And globally, why it's not too very popular is the following: that valuation per se, it's an evolving profession, and valuation globally standards are all still at a evolutionary stage. There maybe it's hardly 10-15 years of stage, 10-15 years of evolution. At some point of time, I expect this change to happen. One area where the change has already happened is in the context of investment properties. In investment properties, where you are holding it basically for rental income and capital appreciation, IAS 40 gives you a choice of following cost model or revaluation model. Globally, many of them follow the revaluation model. So there it's already evolved. So as far as the others are concerned, it's a matter of time, and it also depends on how much pressure is there from the users of financial statement. As you rightly pointed out, there's a cost for revaluing. You have to appoint a valuer, etc. One point I would like to highlight on revaluation is, revaluation need not be done every quarter or every year. It can be done once in 3-4 years, except if there is a change in environment in between, then you have to revalue. Otherwise, revaluation model does not mean every year I have to revalue. It requires you to revalue once in 4 years, once in 5 years. So, but if there is any change in between, which warrants you or necessitates you to relook at it, you should look at it. For example, I was following revaluation model, and 2019 I have done it. So I can revalue next in 2023. But 2020 we know is an exceptional period. So that valuation which I did really does not hold good. So I have to necessarily revalue once again, find the value and do it. So globally it's still picking up. But the standard per se allows it. That much I could share.
Yeah, Professor Ji, are you happy? Can we move to next? Yeah, now I will unmute Mr. Vivek Bhardwaj. Mr. Vivek Bhardwaj, you are unmuted. Next. Mr. Ketan Bhatt. I am unmuting Mr. Ketan Bhatt. नहीं भारद्वाज को कह रहे हैं unmute. Yeah, Ketan Bhatt, you are unmuted. Mr. Bhardwaj को. Mr. Bhardwaj, now I am making you unmuted. Vivek Bhardwaj. Yeah, you are unmuted. Please speak on.
Sanjay bhai, there is one question in the chat box. Can I answer? Okay. So there's a question on the chat box regarding the bank's readiness for Ind AS. In fact, banks, as we know, you have public sector banks and the private banks. Private banks definitely have lots of capital raised from the global investor community, and they are pretty much ready. In fact, few of the private sector banks like HDFC, ICAI are listed globally, and they actually prepare as per US GAAP. So provided we move to Ind AS, they'll be more than happy to do. And among the public sector banks, my informal information which I gather is that State Bank is actually ready to move to IFRS. In fact, there are many subsidiaries which any case do in Ind AS and all. They are pretty much ready to move to Ind AS. And as far as the other public sector banks are concerned, there are these mergers, etc. happening. Probably once some amount of stability arises, the regulator is likely to take a decision on the date of applicability. There are also some minor legal issues like amending the Banking Companies Regulation Act for format of the financial statement, for treatment of intangibles. So there are some minor regulatory changes also which are required, which the Department of Financial Services under the Ministry of Finance is conscious of. So I expect banking system to soon move into Ind AS. I think we should give them that little freedom. I think the regulator is a very mature regulator, and they know when it is best for them. I think we should be patient on that.
Arya Soniji, you are unmuted now. Please ask your question. Arya Soniji, you are unmuted. Mr. Ketan Thakkar, MPV sir.
Yeah.
Mr. Ketan Thakkar wanted to know how can a fresher student who is interested in IFRS can get exposure.
Okay, there are 3-4 questions.
You are a master of
No,
everything.
no, okay, there are a few questions in the chat box. Let me answer all of them.
Yeah.
The question of Mr. Thakkar. I think, like most of these subjects, I think we get expertise only when we apply the standards, when we get to use them. That's when we get it. So I think the best way to get exposure is, I don't know whether this person is interested in practice or industry. Whatever is the role, I think while you will get a theoretically good knowledge, that knowledge is unlikely to give you a good understanding unless you have actually applied it. And best way to apply it is to get engaged in assignments involving preparation or audit of those financial statements which are under Ind AS. The other, let's say, assume I'm in the teaching fraternity and I still want to learn a little more. There are some opportunities, like from the institute, we have the expert advisory committee opinions, which are on application issues, live practical issues on application. That also gives good insights on the implementation aspects and gives you that deeper understanding. Then from the institute, we have this education material. So far, about 18 standards we have issued. If there are 30 questions on an average, 20 questions might be more knowledge oriented, but 10 questions definitely are practical implementation issues. So they help you to get that practical perspective. And the ITFG, we have so far issued about 150 questions we have answered. All of them are practical questions. So they also give you that feel of how the practical issues are to be applied. Then there are a couple of other questions. One is on recent amendment in Ind AS 116 regarding current impact of COVID-19. It will take 2-3 minutes, but let me explain. I'm very happy somebody is chosen to ask this. This is an amendment which was notified on 24th of July 2020, and it's applicable for annual reporting periods beginning from April 20 or for the previous year 19-20. If you have not finalized your financial statements, you can still apply. What this amendment briefly deals with is between landlord and tenant, lessor and lessee, between landlord and tenant. Because of COVID, there is a possibility that there can be waiver of rentals. 2 months rental can be waived, 3 months rental can be waived, or the rentals can be reduced. So I reduce the rentals by 20-30% and I'll add it up later. What IFRS 16, which is Ind AS 116 says is, whenever there is a modification of your lease terms, you should remeasure your asset and liability. So I had an original payment schedule. Now there's a revised payment schedule. So I should calculate what is my revised liability as per the new payment schedule. So remeasure the liability and the asset. That's what needs to be done. But in practice, there can be some lessees, tenants, only for tenants. This is an amendment applicable only for tenants, where it gives an option. It's not mandatory. It gives an option as a practical expediency. There can be some lessees who may have thousands of lease agreements spread across the country or the globe. For example, I am Pantaloon. I have some 500 showrooms all over the country. Or I am a telecom company. I have some 7,000 towers across the country. And the rental agreements for this. So these rental agreements, when there is a rent waiver for 2 months, rent waiver for 3 months, if you have to remeasure and calculate, it's a very cumbersome process. There's so much of spreadsheet calculation, etc. involved. Some cases, the IT systems also have to be tweaked. So what this amendment says is, subject to certain conditions. Like, for example, the landlord-tenant rent concession should be only up to June 21, and because of COVID. It should not be a restructuring of a rent agreement for other reasons. So it should be only up to that. and the revised rentals should be substantially the same or less than the existing one. So there have been some tight conditions placed. Subject to that, what it says is, if you have a waiver of rental, you need not remeasure your liability and asset. The waived portion, you can take it to P&L. So unpaid rental, you can take it to P&L. Or the discount portion of rental, you can take it to P&L directly. So you need not go through that complex calculation process. In simple, that's the amendment of 116. Then I think it's moving fast down. The other question is, what's your opinion about insurance company applicability for Ind AS? It's currently IRDA has not allowed. In fact, it will answer one more question also. Can companies who are less than 250 crore net worth, can they follow Ind AS voluntary? Answer is yes. Yes. But banks and insurance companies cannot follow voluntarily also. They have to wait for their concerned regulator, RBI or IRDA, to allow, and consequently insurance companies can follow Ind AS only after IRDA announces the roadmap. It's most likely to happen from either 22 or 23. We'll wait for it. Hopefully in the next 6 or 7 months, we'll get some insights onto that. Then there is a question on...
MPV sir,
yes.
There is one Mr. Himanshu, he want to talk to you.
Yes,
I'm unmuting him.
Yeah.
Himanshu, you are unmuted.
Yes, sir. Hello. Am I audible, sir?
Yes, yes.
Himanshu, please go ahead.
Sir, I'm doctoral research in... So I answer two
Himanshu, your voice is breaking, but I saw the question in the chat box. Can I respond?
Relevant, but yes, sir. Yes, sir.
Himanshu, I've seen your question in the chat box. Can I respond? Is that fine?
Yes, please respond in the chat box because he is not audible.
I've seen that. I'll respond. So Himanshu, you brought out a nice point that there is a compromise between reliability and relevance due to IFRS. Fair value assessment is more relevant while historical cost is reliable. Let me explain this. As far as fair value is concerned, there is a fairly objective way of arriving at the fair value. Now, and there are enough disclosures on what has gone into determination of fair value. I'll give you a very simple example and you do the test for yourself. Take, for example, actuarial valuation of a retirement benefit, gratuity. Now, when you do a actuarial valuation, you do a present value. So when you do a present value, the discount rate which you choose is a very important rate. Or most of us choose around 8%. If somebody chooses 7, the liability will be higher. Somebody chooses 9, liability will be less. But if you do a dipstick, randomly take 10 listed companies or 30 listed companies, you will find that almost all companies would have taken the same 8 or maybe 7.75 or 8.25. So it is all within a fairly narrow range. And as far as the investors are concerned, when they do the evaluation for investment, and there is disclosure available in the standard itself as to what is the sensitivity analysis of different rates. So when it comes to fair value, what is important is while reliability is important, relevance is also important, and we need to strike a balance. That is why I told you in Ind AS, it does not force you fair value. For property, plant, equipment, it's a choice. Inventory, NRV, obviously it has to be determined. Only in the case of investments, you have to do the fair value because your intent of buying, selling investments was to get the benefit of those movement. And if that movement I don't capture, which means I'm not accounting for the purpose for which I bought. The purpose for which I bought was what? Is to make that gain. And if I make a loss, I have to capture it. Consequently, that gain or loss needs to be necessarily captured. So that's on the fair value part. Now, let me come to the other question, the other point which you made, Himanshu, regarding level 2. In fact, because of level 3 concerns only, globally, the people have still not moved into revaluation model because we don't have an active market for property, plant, equipment and all. Level 3 is more about your cash flows, projections, and there's the possibility of bringing more amount of your judgment. Ultimately, market is king. Market decides what is your worth. So that is why level 3 is considered to be a lower level of reliability. And that's why for property, plant, equipment, people have still not moved in that direction. Now,
Dr. Indraka, I'm unmuting. Please ask your question.
Yes, sir.
Yeah, you are unmuted. Please ask your question.
I have a small question that the government accounting standards, we have Indian accounting standard and international accounting standards. Is there any discussion about this, sir?
Yeah. As far as government accounting standards, there are two things, sir. There is the public sector accounting standards, there is government accounting standards. As far as the public sector accounting standards are concerned, they are basically meant for utility organizations, local bodies and all, which currently there is no mandatory requirement. As far as government is concerned, there is a body within the government called Government Accounting Standards Board. And my little experience, I have very little experience on that. My little experience, having attended 2 meetings of that GASP on behalf of the institute, they are basically building consensus with the various state governments to move to government accounting standards, start embracing accrual and all. You are aware that in the institute, during the presidentship of Ms. Nilesh Vikamsey and when he was vice president as well, we had taken up a project of moving Indian Railways to accrual based. A lot of work has been done from the institute to enable that accrual. So we have completed our part of it, but it's largely a policy decision for the government to embrace the same. So it's early days as that, and I think given the current environment, I don't expect things more.
Mr. Vivek, you are once again unmuted. Please ask your question. Now we have to close. Please ask your question. I don't think you are getting in.
Sanjay, there is...
Yeah, you can read the question.
Sanjay, sir, I have one question. Can I ask?
Yeah.
Avinash, you are in Goa and you are actually intimidating all of us with your T-shirt, light color blue T-shirt and all. Not fair at all. Not fair.
Yeah, Avinash, please.
MPV sir, so because I am also from a tax background, so I just want to ask one question from your presentation. Sir, in your presentation, you have shown the difference between the Ind AS and IFRS for various companies like Infosys and others. Now, I just want to ask, whatever is the difference in the revenue side, it got in the next year, whether the same got reversed or not.
Indraka. You can ask Indraka. Indraka and T and around the last.
So my question is whether the difference in the revenue got reversed in the next year or it will not get reversed, because the point what I am making is income tax department may say whenever there is a less revenue to be recognized, they say no, you go to the normal accounting standard and will increase the revenue. So that's the question I want to ask.
Avinash, over the contract period of the revenue, the total revenue will always be the same. It cannot exceed that. If the contracted revenue is 100, maybe in a particular gap, I may recognize 70 now and 30 over next 3 years. In the other gap, it could be 60 now and 40 over a period. But eventually, it will still be the same. For example, suppose there is a contract where I collect the dues over the next 3 years. What Ind AS says is that 100 rupees is the time value of money, because you are going to collect over 3 years' time. So show 90 rupees income now and 10 rupees time value of money, show it next year until you collect. That is the substance over form, because in substance, you are giving a financing support to the other guy. So you have to do that. In AS, entire 100 I would have shown it. So those kind of differences are there.
Yeah, any question by panelists? I just need to say that WebEx has reported that somebody has tried to invade from the mobile and your password might be shared publicly. So we would request that please do not share a password with any stranger, and they are investigating and they will let us know that which is the number. Now over to Dr. Anil Kumar for final words.
Thanks, Sanjay.
Before Dr. Anil ji, एक second. Before Dr. Anil Kumar speaks, I believe lot of the members of Indian Accounting Association are attending this and who are, I would say, professors and doctorates who are into teaching. My request would be in those universities, where still IFRS is not there, or even the accounting needs to be enhanced. Even the accounting standards have been modified a lot. Please take it up as a project, and how do we sort of improvise on the accounting standard IFRS and bring it in the curriculum at the college level?
Yeah, sure.
That would be a request to all the professors and the deans and the principals who are watching this program.
Yeah, sure.
Thank you.
Wow, what a session this evening. Galaxy of accounting experts, both from the CA profession and the academic world. A wonderful audience of more than 800 people, consisting of chartered accountants, professors, members of Indian Accounting Association, and students. Just two words, thank you, I think are not enough to express our gratitude to all. For a program of this magnitude, there's so many people who are to be thanked. First of all, I would like to thank Professor G. Soral, our president, for sparing his valuable time and enriching us with his thoughtful insights. His suggestion of collaboration between the academicians and the practitioners is well taken by Nilesh ji, and I think that should be carried forward. The keynote speaker, Nilesh ji, in fact, set the foundation for discussion and deliberations today. Thank you very much, sir, for sparing your valuable time and to be with us. Then, about MP Vijay Kumar ji, we thoroughly, of course, enjoyed your session. I would like to remind you that in 2016, your presentation on Ind AS at SRCC, when same kind of session was organized, was highly successful. And since then, I've been getting, so many requests from my friends, from my colleagues, that why not you call MP Vijay Kumar ji again. So here we had this opportunity of listening to you. And I would agree with Nilesh ji that the two catchwords I would say are that accounting means stay accountable and at the same time to communicate truthfully. On behalf of Indian Accounting Association, Voice of CA Foundation, Voice of CA, and Deen Dayal Upadhyay College, I would like to express my thanks and gratitude to all the eminent speakers today. I take this opportunity to tell something about Indian Accounting Association also, that under the guidance of our president, we are working on curriculum development. As Nilesh ji has just suggested, we have one subcommittee of curriculum development, and Achlapati ji is here, I think is very much part of that committee, and I'm also part of that committee. We are also working on a bigger platform on how to enrich the accounting discipline. And about 5 years back, we started with one program, that is National Talent Search in the field of accounting, wherein we offer some fabulous prizes for a quiz on accounting, which is held every year at all India level. I would like to thank Professor Achlapati ji also for finally making it. There was some problem initially. Then Voice of CA founder, CA Sanjay Agarwal ji and CA Avinash Gupta ji. They work day and night to make this program possible. The support of Dr. Hemchand Jain, Principal of Deen Dayal Upadhyay College, has been immense. The executive body of Indian Accounting Association, Delhi chapter, deserve all appreciation. We had many stalwarts from the accounting profession here, many practitioners of chartered accountancy. Our thanks to all of them. And above all, but not the least, it is the participants who have made this program successful. Today, we had more than 800 participants, and of course, the registrations were more than 1800. I do hope that in another 2 days program, we will have more participants joining us today. I would like to remind the participants also that tomorrow we will have the program starting at 11 o'clock in the morning, but then you need separate registration for attending tomorrow's program and on Sunday's program. So for that, if you have not made the registration till now, please do it today night itself. So thank you very much. Good wishes and good night, everyone. Thank you.
I'll just say before departing for today that the man behind organizing everything is Avinash ji, and for answering the younger blood, Mr. Karthik is there, and they will continue for all the 3 days. And MPV sir, please give your showering every time. We'll organize this is the first beginner, and in every you can say certificate course you need to be there. And I'm also thankful to my past president Nilesh ji for today's presence for the whole day, though he said that I will be available only for 15 to 20 minutes, but he remained for the entire session. Thank you and good night. Shabba Khair. Thank you very much.
Thank you, sir.
Thank you, sir. Thank you.
Thank you, sir.
Thank you, everyone.